All right, everybody. Looks like we are now getting connected up. We are live on X. We're live on YouTube. Thank you, everybody. We already got over 50 people in here. That's great. Welcome back to another Cash Flow Chronicles. Another great day. We have a backlog of topics to talk about, and so we could start off any which way, shape, or form. But what I will start off with is May 22nd, 2025. The markets have been on a pretty good run, but we're pulling back a little bit. Apple at 201, Amazon 202, Bros at 68, Google at 171, Palantir at 123, Rocket Lab at 26, SPY at 583, the Qs at 513, Bitcoin at all-time highs, 111,000, oil $61, and Henry Hub gas $3.27. Mr. Patel, how are you feeling? Are the markets going to zero today?
No, man. I mean, we're just getting some stabilization in the markets. I think valuations on certain companies are still extended. So, applying some caution here and there is not a bad idea. The bond market is actually interesting to me right now because I think there might be some oversold conditions in the treasuries because the data that I'm seeing, and we'll go over some of that data, it's pointing towards a lot more caution than what the market is letting on. So right now, a lot of people are paying extended prices for certain equities, especially if you're buying the plain index. So you're buying a high premium. And on the other hand, you could get a fixed guaranteed return with zero risk on the other side, on the bond side. So from an equity bond perspective, it's kind of like, hey, listen, the bond market's a little bit lopsided in terms of risk-adjusted returns. So you kind of want to focus some of the attention over there. So
can we dive deeper on that? I'm not smart. So all I did was I looked up the actual auction, and I'm no genius here. So what I've seen over the past few months, and so correct me if I'm wrong, like I said, I'm no genius when it comes to this. There's been about $35 to $40 million of people for these 20-year treasury bonds, of people that are bidding, right? Of which we've seen anywhere between 13 to 15 million of actual tenders. What I saw was
billions.
Sorry, billions. Thank you. Yeah, millions won't do shit. So thank you for the correction. Yeah. It didn't look any different than the previous auctions. So I'm kind of curious. We still sold over $14 billion worth of 20-year treasuries. It was comparable to what we've seen over the last few months. Why is this so drastically different?
So one of the reasons why is because if you look at the actual yield on the treasuries, they've been going up because yes, there have still been treasuries that are issued are still overbid, but the cost is higher than what, or at least the yield that requires people to be in the market is markedly higher. So if you look at right now, let's say you took, and this is where mark to market is actually very important, right? So let's say I go out there with a 5-year treasury and I'm like, oh, not 5-year treasury, like a 5% bond, a 20-year, right? And investors are saying, yes, I'll bid on this, but I'm not going to accept 5%. I want 5.1%, right? So that is the thing. So the tail is what actually determines where that yield actually ends up. And then if you look at on the secondary market, when people can just buy and sell freely, the value of that thing, it shot up, which means that investors are asking for more yield to compensate for additional risk. So, it's almost like the bond market is saying like, hey, listen, we think the U.S. government cannot fulfill its obligations. So we require them to give us a higher yield to make up for that difference in risk. So that's what it is. So it's not necessarily just the total number of bidders out there. So think of like you think of you going to the auction, right? You've been to you've seen an auction, right? Where the guy's like 5, blah, blah, blah. Imagine right now you're sitting there, there's 1,000 people. There could be 1,000 people, there could be 100 people, there could be 1,000,000 people in that room. But that's not what determines the actual price of that object that eventually gets sold. It's what the investors are willing to pay for it. So if someone says, I'll buy it for 200, another says, I'll buy it for 300, the value isn't, oh my God, there's 1,000,000 people here. Look, no, it's out of those 3 million people, the highest bid that someone's willing to give is $300. So that is what the price of that object is. So when you see yields climb up, that means that, hey, regardless of there's 3 million people or 800 million people in that room, It's what the final yield of that thing is going to be. So whenever you look at like any sort of auction, you're not looking at, oh yeah, look at how many people showed up to the auction. That's irrelevant. One person could show up to the auction. Okay. That doesn't matter. That's not what actually determines the value of the object. It's what someone is willing to pay for that object. That's what's going to
I don't know,
determine.
man. The yield is a factor of the fact that, you know, they downgraded our debt. Several credit agencies downgraded our debt. To me, what would have been really scary is that people aren't showing up at all, regardless of whether it's 5%, 5.1%.
There's a good amount.
Maybe I'm naive. Maybe I'm naive in that respect.
Well, it's not being naive. What it is a lot of those people that are in that room, they're obligated to be there. Like JP Morgan is obligated to be in that room bidding on shit. All the other banks that are in there, they're obligated to actually buy a portion of it. So it's not like, oh, you know what, these people here because they love it and they're interested. Like, no, there's certain people that are in there because they're obligated to actually be there. So that's one of the things that we have to remember. Also, the amount of interest from foreign buyers, that's another thing to consider also. So as our debt rolls over, we have to issue new debt. The challenge is if the next person says, hey, listen, I know I gave you money last year at 3%, but this year I'm only going to give it to you at 5%. The value of that debt is going to be 5, you know? So once again, the number of people in the room is not nearly as important as the final price at which everyone says, hey, this is what's going on. And this is where I think a lot of things got caught off guard a little bit, saying, look, Bessent is a markets guy. Usually the treasury, knowing that they have an auction coming up, and if it could be really detrimental to the bond market to have it a lot more quote unquote free, they can jawbone a lot of people into being present and bidding things up. So the consensus was Bessent is going to be out there before the auction takes place and cajole people, hey, you better goddamn buy some treasuries and you better pay a good price for it, so that the auction itself went over without a hitch, but it didn't like basically extend out. So the demand for treasuries is still there. It's just the total yield is the problem. And that's why, like I said, that's why you got like a 5 and something change instead of 5. I mean, if you really think about it, Matt, if people really, really super wanted our debt because they felt really good about it, they'd be willing to accept 3%, right? Like they did 4 years ago. But their thing is inflation is running hot. This administration is doing everything in their power to increase the debt with their current policies, right? They have a massive amount of debt. So we think, just to be safe, we are not going to accept a lower yield. You know, and once again,
you can't say they'd accept 3%. I mean, yes and no. I hear what you're saying, but at the same time, I mean, the federal funds rate is, you know what I mean? Like, you can't be lower than the federal funds rate on a 20-year, 30-year bond.
Yes, you can. Yes, you can. That's why we get inversions. That's why all throughout last year, the markets were inverted. You could get 5.5% on a 1 to 2 year treasury, or even less, right? On a bill. But on the long end of the side, you could get it. People were willing to pay 4 for it. Why? Because the expectation was within a year, the interest rates on the short term would be a lot less because the Fed was going to cut 6, 7, 8 times. So, you know, when it comes to investing in bonds, like if I told you right now, Matt, what do you want to do? You want to lend me money for 1 year for 6%, or lend me money for 30 years at 5%? Now you're thinking to yourself, okay, if I lent this guy 6% today, that means a year from now, if things are much better, and this guy comes to me and says, hey, I'm going to only give 4%, right? As a thing, that means that I'd rather just go in the long end and buy the long end and sell and basically get a nice lock-in 5% yield, right? So that's why you have yield curve inversion. So right now, the expectations are with these tariffs, inflation would go higher, right? And the deficits, like this big, beautiful bill, would add to the deficits, which means that a lot less people are interested in U.S. debt at a price that's like 3%. The other thing is the U.S. dollar is weakening. If the dollar was super strong against every other currency, you'd be like, look, I could buy a 3% yield here and still make money because I'm still getting a strong dollar. Right now, if the goal of the administration is, hey, we want a weak dollar so we can boost our exports and reduce our imports, that means that from an FX exchange, if you're a European, you're thinking to yourself, wait a second, why would I want to buy a treasury that's denominated in US dollars with the administration's goal is to devalue themselves? Would that make sense?
So let me ask
Yeah.
you mentioned the deficit. I mean, the big beautiful bill, or whatever the hell it's called, today that was passed. I mean, do you honestly think that that's going to add that much deficit to the current deficit that we already have, or do you think that that's kind of going to help spur growth? Right? I mean, no taxes on tips, no taxes on overtime. The big thing that I see a lot of people complaining about is the fact that he didn't get the Social Security piece passed, because obviously, he was hoping to get removal on Social Security, which I agree. I think that's kind of bullshit, but in my opinion. But no taxes on American-made cars. A lot of good things that I think would help kind of spur economic growth a little bit, maybe, for very little removal of potential income from the system.
I agree with you on that.
I honestly think that, yes, maybe it increases the deficit slightly, but I think the benefit, especially on the younger people, is much bigger than the impact of the deficit.
I think the administration's goals are correct in the way that they're doing them. They're essentially saying, like, here's an example. They said, look, we have so many people on Medicaid. What if we got these people to actually go get a job and become contributors to society? That would grow our GDP. Imagine right now, there's 1 million people sitting on Medicaid right now that are young working age adults. These are like 25-year-olds that can't find a job. They're on Medicaid right now. So they're saying, look, if we encourage people to get more jobs in America by limiting, what is that thing called? Imports, more people in America will have a job. And these younger people, especially like in their 20s and 30s, they're not going to become a lost generation of people relying on government subsidies. If we can get them to actually become contributors as taxpayers, that would be good. So let's boost up our actual domestic manufacturing and domestic workforce and all the other good stuff. So I totally agree with that. Like, I think that the administration is doing right. The challenge is, how do you quantify that? It's easy to quantify the no tax on tips thing. You take, right now, there's 4 to 5 million people in the country who work on tips. The average person that makes tips, they make base 35,000 with 15 to 20,000 in tips that they actually make. So you're making literally like $50,000, $60,000. The median income in the United States is 80,000. So these people are below the median income that's out there, right? So a lot of people, they look at this like no tax on tips, like, oh, these people are getting this giant benefits. Like, wait a second. First and foremost, these people pay barely 10% in marginal tax rates because they don't make that much money to begin with. Okay. Yeah. Number two, there is a cap on how much they can put in tips. It's not like you could, like, oh, I'm a stripper and I make $200,000 on, in single dollar.
The problem is that cash tips you can kind of hide, right? But a lot of people are paying tips on credit cards. Like myself, I barely pay cash tips, right?
Matt, I don't think there is I haven't paid a cash tip in literally probably like 5 years.
Yeah, so that automatically gets reported, right? I mean, you can't hide that. So unfortunately, people are going to have to pay if they make over 50, 60,000, they're going to end up paying taxes on that. Anyway, I would love to continue on this topic, but we have a lot of shit to go through. And so I apologies for cutting you off, but I do think we didn't get to VG last time. I know that's a big topic we want to talk about. We need to look at the portfolio, show people where we're at with that. And then obviously a lot of people are here. You've been doing some due diligence with respect to ASTS. You've been having a lot of people in your Discord and your Patreon looking at it. I'm curious to hear your thoughts because I know it's something that you said that we need to personally buy in the portfolio. Luckily for us, we're getting a little bit of revenue. So hopefully in 8 days or so, if you really want to buy it, we can get a little bit of influx and be more than happy to put some capital to work there, or sell some stuff if we feel the need to sell anything. And then obviously RKLB. I'm curious what your thoughts are. Why you're still potentially eking out in an investment in ASTS versus RKLB, because it's something that you've said that you've done a little bit more research on since the last time we talked.
So for me, when I look at ASTS, I see a long stream of revenue that could be coming in with a much more durable moat. The reason why I say that is because, spectrum is one of those things that's actually very limited, right? So the way that ASTS is setting up their business, it's going to be, you know, it's going to be like space communications as a service. So same concept as American Tower, same concept as, these tower companies, except now instead of just having towers, you've got also satellites up in the air in space. And basically the revenue model that they have is the MNOs would be the ones that are still charging the customers. They would end up just collecting a small revenue fee from that. So it's very similar to how American Tower does their business, right? So it's almost like you've got this rental model with this long-term revenue stream that's coming in, that you're not going out there having to do all this additional marketing. You're not going out there to have to develop customers. Your job is, you've signed a contract with AT&T, you've signed a contract with Verizon, you've signed a contract with Vodafone, where you're going to supply backhaul service with these satellites, right, to give high broadband connectivity in remote areas. Like, that is what you're doing, and that's like your entire focus, which is totally cool with me. That is it. So for me, when I look at the business model, I'm like, oh, that's a lot more guaranteed. With Rocket Lab, I think it's a lot more capital intensive.
So before we get into Rocket Lab, I want to give people some background in AST. So AST Space Mobile, as you kind of alluded to, they're trying to provide kind of like a Starlink service, an internet service utilizing satellites, to give people an idea as to where they are in their journey at the moment. They have a prototype that's been up in space since 2022. It's the Blue Walker 3. They've recently, in September, October timeframe last year in 2024, put up what they call the Bluebird 1. They put, I think, 4 or 5 of those satellites. Those have been tested with Verizon, AT&T. Those have made phone calls, FaceTime calls, etc., without a modified phone, so just like a normal iPhone or anything of the like. So giving people some context there. And the hope is latter half of this year, and I didn't know if you were going to get into this or not, so apologies if I steal your thunder here. Later half of this year, they're predicting that they're going to get some launches off with their Bluebird 2, which would then allow them to start ramping up and potentially start getting revenue. I think they forecasted fiscal year 25 of having $50 to $75 million in revenue. And give people some context on the current revenue, Chris, and then curious to hear your thoughts about Rocket Lab.
Yeah, for me right now, when I look at the business, I'm not looking for today's revenues because they're not fully launched yet, right? So they're pre actual profitability. But the thing with me is that the revenue model is very similar, like to the cell phone tower business, where once you launch it, you've got now all the capital expenses that are going to be front loaded. The rest of the time, you're going to be generating this cash flow. And the other thing is, incrementally, that cash flow is going to grow because you're going to get more people on the consumer side, right? And then you're also going to get incremental revenue increases from your partners. So over time, you're going to basically grow your base. The difference between, let's say, American Towers, the American Tower actually had to go out there and build a whole bunch of cell phone towers everywhere. These guys, they launch a satellite and boom, now they have connectivity. Now, yes, there's going to be competition out there like SpaceX, even other ones like Eulsat. I forgot what the other like major satellite providers are. Rocket Lab too. Rocket Lab is launching their own constellation. But the thing is, when it comes down to the technology portion, the most important thing is actually spectrum. That spectrum is what's going to give you the ability to actually connect down there. And the way that it works is that, it's almost like real estate. Like, having real estate doesn't mean like, oh, you could have the shittiest building in Manhattan, but it's going to appreciate significantly because they're not making any more of it. So right now, all of that spectrum that ASTS rides on, all that spectrum has been provided via the MNOs that already exist. Right. So right now, the technology that they have uses that spectrum as an advantage. Now, the thing is, you can't go out there and buy more spectrum, like, or at least within those specific bands that are out there. So ASTS has that band partnership that makes them basically have that moat. So that's the major thing. So even if, let's say, 100 satellite companies were launching, they don't have that specific bandwidth that's required in order to get that signal and that technology to work as clearly as ASTS does right now, and they could do it without having like additional equipment. That's one of their biggest draws, that, hey, they can just basically project a signal down there at the current frequencies that they have, and it's a seamless integration, you know.
Mm-hmm.
So,
At the moment, I know that at least from what I'm understanding, ASTS is going to be utilizing radio frequencies. Other people now think that the forward movement or the top tier technology for satellites will be utilizing lasers. That's a piece that maybe we can get into in Rocket Lab. We mentioned that. I think that is also what Starlink will be transitioning to as well. So there's pros and cons of both. And so that's not really important for right now, but I think that's I think something that I'm going to be looking out for personally. Will eventually AST be moving to lasers, because I think that will be the forefront. Granted, radio frequencies work well. Obviously, you're able to transmit up to 120 megabytes per second. That's great, especially in remote locations. If you even get a fraction of 120, you'd be ecstatic, because most people can't even get any sort of access to any sort of data at the moment in remote locations. So that's great. The thing that's beautiful with respect to the laser piece is you can do 100 gigabytes per second, which is much faster. Granted, the spectrum and the area of concentration is much less. Obviously, there's complications associated with clouds and stuff like that. Obviously, you can't necessarily get as clean of an image, etc. But anyway, I don't want to necessarily go down that sort of rabbit hole. But curious to see how that evolves going into the future.
Yeah.
So I'm curious what your initial due diligence on Rocket Lab has been.
Okay, so first and foremost, their CEO ate a shoe on TV. Okay. I'm messing with you. I'm messing with you. No, the Rocket Lab is a really good company. Okay, so I'm not gonna say like, oh my God, Rocket Lab's a shitty company.
You don't have to
they don't know
me,
what they're
man.
doing. I'm not trying to appease you.
I'm
for me, when I look at Rocket Lab and I look at ASTS, and the reason why, look, some of this stuff that with ASTS and Rocket Lab, we're just going back and forth. It's just a fun debate that we're having. Okay, it's not like, oh my God, I think Rocket Lab is a shitty company. By no means. I mean, these guys are sending rockets to space. Not exactly the easiest thing on the planet to do. Right? It's actually very complicated with a lot of failures that gets built in. So no, by no means do I think Rocket Lab is a bad company. My thing with Rocket Lab is that from a business perspective, I see that there's a lot of risks in terms of basically capital risk in sending things to space. And then over time, the cost of things going to space become cheaper and cheaper, especially when you're competing against someone like SpaceX and you're competing against actual like countries like India, Japan, and some of the Europeans. And so I think there are so many space companies that are out there. The value of sending things to space over time is going down. And the thing is, if Rocket Lab's business model is, hey, this is the cost to serve, and we're going to be one of the components to that, and the whole goal is to disrupt each other, that's not as durable of a moat to me in terms of total pricing in the future. So once again, if it was like, hey, look, Rocket Lab is the only technology to get people into space and no one else has that technology, I'd be all for Rocket Lab 100% without any doubt in my mind. Be like, look, this is the only way you're going to get to space. They can charge whatever they want to charge. That is a moat, but that's not the case. And as SpaceX and these other major companies become better and better at launching things into space, and they can do it at a cost that's even cheaper, that means that every time Rocket Lab launches a rocket, become less profitable because now they have to compensate for their competitors being able to launch things at a cheaper price. So it's almost like a race to the bottom business. That's my only gripe with Rocket Lab. So if they can create, other sources of revenue, that are a lot more durable, I think Rocket Lab is a great company. I'd love to.
Did you know that 70% of their revenue comes from space satellites and creating components for other satellites?
I did not know that, actually. But I thought
you told me you did your due diligence, man. I'm actually.
I thought their core business was launch services.
I thought you did your due diligence, brother.
I thought I did too. I mean, that's what they essentially.
No offense.
Showcasing.
it's literally, you pull up one investor presentation, you would know.
But that's what look at their investor presentation right now. What did they say in that? Let me see. Investor relations. Nowhere do they say like, hey, we're trying to build a durable business that is based on X, Y, and Z. They say, oh, look, our goal is to get heavier and heavier rockets into space.
Pull up the investor presentations.
All right, let's take a look. Their latest presentation.
You're the one that's going to end up eating a shoe on this fucking podcast.
Jeez, man, don't take it personally.
All right. I'm honestly thought that you did your due diligence.
Right here. So they build spacecraft components and then launch services, right? Like there's
and you told me all they did was launch.
Yeah, but the components part is not that big of a deal to me. And they don't even report that as a line item yet, do they? Come
on, man. Did you get to slide 3 and said you know everything about RKLB?
Look right here. I'm at slide 7. Okay, and they're already like, look.
Go to the revenue slides, Chris.
Okay. Neutron. They keep highlighting the rocket. Look at this rocket. Like rocket assembly in progress. Neutron launch schedule. So it's all about the rockets. Progress to launch pad. More rockets. Hey, look, space systems. Okay, right here. Minarak, important element. So this is like satellite to satellite communications. Working through the process acquiring Minarak. So this is an acquisition, the latest one. Supplier to commercial constellations. Pending completion, we continue to serve existing customers, tap into our scale, and expand production and enter new markets. This is completely new for them. Vertical integration for satellites. Let's see. Third Pioneer spacecraft in space. I'm trying to understand like all of product expansion. Customizable modular solar arrays. Okay. Everyone else does that too. Expand suite of.
You said something very important, Christopher. You said
What's
something
that?
Very important. Everybody does that too.
Right.
So where's the moat for AST if everybody else does that?
No, I mean, if their thing is, hey, we build components for satellites, bro, there's plenty of people that build components for satellites. The business model is not based on actual service. It's like, hey,
lots of people build satellites. Okay, I'm listening.
Right. So that's what I'm saying. Like, where are we getting all this additional like thing that you're talking about then? Like the future growth that's going to be in providing this service that other people can't provide.
Okay, so you're skipping the revenue slides.
Okay, no, please stop me and tell me.
No, I'm letting you do your due diligence because you refused to do it beforehand. You've kept telling me for months that you're going to do it, and then you told me you did it, and you didn't. So please go back to the original revenue slide and read through that for everybody, including yourself. See. No. Go back down the revenue slide.
Okay. This one right here?
Yes, read through it.
Okay, revenue increased 32% to 29 million year over year, driven by an increase in launches from 4 to 5. Like, okay, space systems business driven primarily by our SDA satellite manufacturing contract.
Do you know what the SDA is, Christopher?
Yeah, they build satellite components for people.
What's the SDA, Chris?
I don't know. You tell me.
The Space Development Agency for Space Force.
Okay.
Thousands of satellites. They're now a prime contractor for the United States government to be able to build these satellites.
Right, but there's so many contractors out there that are doing the same thing. Where's the moat?
Yeah, okay, I hear you. But I'm just saying, you're trying to be. Don't push back yet. You literally didn't think they made satellites a minute ago.
I didn't say that they didn't make, but they make components for satellites. It's not really like a growth business out there, as far as I'm concerned. Right? Or am I wrong here to assume that this is a business where the margins are probably very thin?
30% gross margins. Keep going.
Where is it? Let's see. SG&A. I mean, I'm looking at this. Their cash flows, they're negative, right? They're still spending a lot of money purchase on property, equipment, okay. Operating cash flows actually went negative even further. So Where am I seeing the revenue going the other way, considering that they're fully ramped up in this and they're growing at a 30%?
You're looking at 1 quarter, but okay, that's fine.
Okay.
Get to you skipped the gap margin slide. So let's scroll back to that. I forget where that's at. Let me see.
I think it's further below that.
This one. Here you go.
Okay.
So let's read through this a little bit.
Right. So their gross margin went from Q1 from 31 to 33%. Okay. Their gap gross went up 2%. Okay.
That's not bad.
Yeah, but it's not like growth or like a services business that doesn't have the ability to get disrupted. That's what I'm trying to tell you. Like from a business model perspective, I'd rather be an ASTS than Rocket Lab.
Okay. So let me help you out here.
Mm-hmm.
Nobody can compete with the Falcon 9 rocket at the moment.
Okay.
Within 12 months, Rocket Lab will have a direct competitor to the Falcon 9, which nobody else currently has. It will be reusable, right? $50 million per launch compared to their $8 to $9 million per launch currently for their small launch vehicle, right? You're also missing the fact that HASTE is a competitor for the Golden Dome program. So that's potentially going to help with not only hypersonic testing across the United States as well as the UK at this point. Potentially will grow all the way into Europe. Will potentially be utilized for the entirety of the Golden Dome program. We're getting billions of dollars of potential contracts associated with that, signed with the Department of Defense, and that program is in its infancy as well. So I don't think that you're fully giving credit with respect to, one, the launch piece, and then two, there's the future eventual constellation as well, which is going to potentially compete directly with ASTS. And so I think that,
I don't think that's the case. I don't think Rocket Lab and ASTS are going to be competitors. Once again, it looks like from what I'm seeing, they're like with lasers. You don't have lasers pointing at cell phones in the ground. It's literally like backhaul communications between satellites. I could understand maybe there's some business there, but it's not, hey, listen, this is a direct to consumer business.
We'll see. We'll see.
Yeah. As far as I'm concerned, Rocket Lab is a great company, but the business model that they have right now does not leave a lot of room for, in my opinion, a tremendous amount of growth. SpaceX is different.
Can I interrupt and ask a question?
Well, before you do that,
sure.
The reason why SpaceX is where it is today is not because of its launch services. But by the way, they're great. It's because of its what is that thing called? Because of Starlink. That's what gives them that high margin revenue, that services revenue that subsidizes all the launching. That's why they can do that. As far as what you showed me right now, Rocket Lab is not really providing additional revenue sources outside of, hey, we build components as a contract that, for government agencies.
How much revenue do you think SpaceX had before they had the Falcon 9?
I don't know. They don't publish the numbers like that.
You can find them, but it wasn't very much, right? So Imagine now you unlock a Falcon 9 equivalent in your business. What do you think is going to happen?
I mean, they're going to launch things into space.
So let me ask a second question. Do you think SpaceX is a bad business? Do you think the business model is working, not working?
I think it's working really well. I think it's
so
working.
What do you think that Adam Spice as well as Peter Beck have stated explicitly that they truly believe in the SpaceX business model and they trying to replicate it in some sort of way, shape, or form?
Yeah, well, that's the thing. I'd rather invest in the services part of it, not the launch services part of it. As far as I'm concerned, Rocket Lab is more concerned with getting things to space than, hey, let's build a business model in space, Or at least that's what I'm thinking. Okay, if you're telling me like, hey, you're wrong, they're actually building a much more durable business with better profitability, I could be wrong. Okay, if you tell me, hey, Chris, do you want to invest in the company that builds cell phone towers, or do you want to buy, invest in a company that owns the cell phone towers and rents out the spectrum? I'd rather be in the second part, right? It's almost like, hey, would you rather be in the home builders, or would you rather be in the people that own all the homes and basically are charging people rent? Yeah, of course. I'd rather be in the part that generates that rent revenue because it's durable, it's stronger. You're gonna have it continuously flowing into your business. The other one, it's like, hey, listen, launch services are really attractive. Maybe 5 years from now, they're not as attractive.
Hmm.
You know, I mean, is that fair to say?
What would make them less attractive?
What do you mean? What would make them demand for launch services becomes cheaper, and
How?
so now you're competing against other people.
Cheaper?
Say that again.
Has Falcon 9 become cheaper?
Yes, on a per weight basis, it's become much cheaper to launch things into space. Where NASA used to launch things.
No. I mean, since Falcon 9, right? Mm-hmm. Has their cost per launch gone up or down over time?
I think you're thinking of it differently. Even if their cost per launch went up, the amount of stuff that they fare to space has exceedingly gone even further than that. Even Elon talks about it. The cost of putting things into space has gone down over time.
You're missing my point. You're saying that basically the cost of things is going to zero, right? That's basically what you're saying, right? So let me ask a serious question. We know the Falcon 9, I'm just throwing some simple numbers out there. The Falcon 9 can put about 20,000 kilograms worth of stuff into space. It costs about $70 million to get on a Falcon 9, right? Mm-hmm. Rocket Lab can do about 15,000, so about 25% less, but it's $50 million, right? So majority of companies that are utilizing the Falcon 9 are not using 20,000 kilograms, right? From the study, it's been about 3,000 to 4,000 kilograms. So let me ask you a serious question. Are you going to utilize the Falcon 9 or are you going to use the Neutron? The one that's literally 20-30% cheaper.
Whichever one is going to give me the best amount on terms of space. Like they're not like SpaceX is not just ferrying one company to space on a launch. They're doing multiple satellites.
That's what I'm saying. I'm saying $3,000 to $4,000 kilograms on average, right? So 70 or so % of the Falcon 9s generally go unused of the total capacity, right? So let me ask you again. If 3,000 to 4,000 on average, yes, there's going to be some that Falcon 9 can lift, and there's going to be some that the Neutron can't lift. That's going to be in there for sure. But of the average 20 last launches that the Falcon 9 has done, not for Starlink, but for other customers, it's been 3,000 to 4,000 pounds on average.
Right.
So are you going to choose a $50 million rocket that's reusable since day one, or the Falcon 9 rocket that was retrofitted to be reusable and costs you 30% more?
Yeah, but even then, Matt, there's other
answer the question. It's a yes or no.
But even then, if you're okay, from what you're telling me right now, this is what Rocket Lab charges, and still they're not profitable. Okay,
they haven't even launched the rocket yet.
Right, but that's what I'm trying to tell you. That so you're basically betting on, hey, they're going to be a competitor to SpaceX, but at the same time, SpaceX is also launching things, and their goal is to make things even cheaper. Like, why would you compete against them for that? I'm just saying, like, the cost for SpaceX is going to get cheaper and cheaper over time. Even Elon is focused on that. Like, your competitor is Elon Musk. I'm not saying that you're not going to do well as a business. I'm not saying that at all. My thing is, it's going to be a lot more difficult, and it's going to squeeze your margins every time. And the cost of capital that you have to keep putting into the business is going to be significant over a long period of time.
I don't think you fully understand. You're not fully understanding, Chris. You're going to be able to launch and reuse these rockets 20 times before you have to expend them.
Right, but then there's SpaceX is doing the same thing, and all these other guys are focusing on doing the same shit.
Well, you're telling your margins are going to go to zero. I mean, I'm just trying to push back on the things that you're stating.
No, that's fine.
I think you know what I think, Chris, and
I think we should buy both and see who performs better over time. I mean, we're going to be friends 10 years from now.
I think you're pushing because you're trying to stir some sort of like competition. But at the end of the day, I'm just very frustrated by the fact that you told me you did your due diligence and to be very funky.
I did, dude. I did.
There's lack of due diligence written all over this entire conversation.
If 5 years from now, Rocket Lab is actually performs better than, like, right now, I think both of them are $8 billion, right? Like, what's the market cap on both of the companies?
It's around there, 8 to 10.
Okay, if Rocket Lab is a bigger company than ASTS is, let's say 5 years from now. So today is 5/22/2025. Let's say by 2030, if ASTS, I mean, if Rocket Lab is a bigger company than ASTS, I will eat a shoe on live TV or on live YouTube. Okay, but if ASTS is a bigger, I don't know, you got to eat a shoe too. So
Nah,
wait
I'm
a
not
second,
agreeing to
did
that.
Peter Beck actually eat a freaking shoe?
He ate a hat.
He ate a hat. Okay.
Yeah. So he said that he was never going to get in a medium launch. And then as soon as they not direct listed, I'm sorry, they de-SPACed, they got $750, $800 million in investment, to which they bought a lot of their space systems businesses, multiple, 4 or 5 like key acquisitions. They announced that they were going to do the Neutron, and the Neutron was something that he said they were never going to do.
Yeah.
He probably never thought they'd get that far, to be honest with them. Maybe he did know that. Maybe, I don't know. I'd actually like to ask him about that now that I've had a few conversations with him. But
yeah,
hey man, I mean, to be very frank, this founder is from New Zealand, where they don't even have an aerospace program, and was able to bootstrap his way up to build $1 billion, $8 billion, $9 billion, $10 billion rocket business as you see fit. NASA told him to go kick rocks. I mean, that alone, I mean, I'm not saying you need to knock Elon. Elon obviously took his $280 million that he made from PayPal and did what he did, right? So you can't scoff at that either. But this guy was literally able to create a rocket program, in my opinion, out of nothing. And now you're potentially going to have a rocket company spanning 3 continents. That's pretty impressive. They're in New Zealand. They launch in Eastern Virginia, and then they're hopefully going to be finding some sort of potential launch vehicle or pad to be launching out of Europe. I mean, that's pretty impressive.
No, it totally is. And to be honest, you're absolutely right. I am leaning into the SpaceX, the ASTS versus Rocket Lab debate, because there is such a heated conversation on Twitter about the ASTS bulls versus the Rocket Lab bulls. And the thing is, like, for me, I'm trying to be as objective as possible. And when I look at it, I'm like, look, I just like ASTS's business model more than I like Rocket Lab's business model. Okay. It's nothing to do with individually liking the company or not. You know, you can like a business because it has a certain quality that more aligns with your goals. Like, here's an example, like, and this is a great transition into VG. Like, me and you are not exactly bullish on upstream natural gas. We're not like, yeah, let's go buy acreage in Haynesville. By the way, we probably should, just to be honest.
Yeah, right now it's not actually that bad of an idea.
Yeah. We're more like, hey, listen, I want to buy this company that's creating this service of liquefaction and charging people fees for it. And it's a long tail, like 20 years of growth in that fee that's getting generated. Like, they're literally signing contracts with, by the way, they're inflation adjusted, by the way, too. So anyone thinking like, oh, like, what if they sign a deal for 20 years and, inflation goes through the roof? Like, no, like, all the deals have inflation built into it. So it's almost like, hey, if you sign a liquefaction fee for, let's say, $2.50, you're not going to pay $2.50 forever. It's, hey, we're going to pay $2.50, but every year when, inflation goes up, that price of that liquefaction slowly goes up over time as well. You know, so one of the things that I like about the business model of LNG exporting is that you're not actually there to produce LNG. So I think this is the hotly debated topic, I think, sometimes with investors. And they're like, well, natural gas price went to $1. Like, oh my God, isn't VG going to like lose all their money? Like, no, they're not actually investing in upstream. They're investing in midstream. Midstream works by eliminating that risk of fluctuations in pricing. Now, one of the risks that Venture Global has, and this is something that they actually addressed a little bit during the conference call, which was they have a larger amount of exposure to floating rate liquefaction than their competitor Cheniere, which has most of their production already fixed. So Cheniere, whether the price of natural gas goes to 1 or 3 or 20, or it's not going to impact them that much. What's going to actually impact them is going to be like not being able to sign future contracts, right? that's the ultimate risk that they have. Same thing with Venture Global. So I think one of the things that Mike, when he addressed it, when Mike Sable is the CEO of Venture Global, one of the things that they addressed was that, and I think this is why the markets kind of rallied a little bit, because the quarter wasn't that great. Okay, let's just be honest. The quarter wasn't like, oh my God, they did really well. And even from like some of the early cargoes, like what they signed on spot for the first quarter of 2026, they were way below what they're getting right now. Okay, so that part I was a little bit like, ooh. But at the same time, the market rallied because they're like, look, we have a bunch of deals in the works. And then on the other hand, you're also seeing companies like Saudi Aramco, ADNOC, all of these major importers of energy on the sovereign side, all of them are partnering with these other LNG producers like NextDecade, right? NextDecade signed a really big deal with Saudi Aramco. And then you have the Trump administration going out there saying to all these countries, buy more US LNG, buy more US LNG. And so all of these deals, as Venture Global signs them, and these are like long-term 20-year deals, it just means that the risk on this business goes from like here to like here. And that's what gives you that huge amount of total upward movement in cash flow in the future, because that's what you want. You want as much incremental cash flow as possible. So right now, a lot of people are scared, saying, well, what if the Europeans, they go back to using Russian gas? That means that now the total demand for natural gas in the future for liquid, US LNG is going to be a lot less, which means that in the future, Venture Global is going to have trouble signing deals with off-takers. And that's contrary with what the data that's coming out. The data saying everyone wants to buy US LNG, and the administration's super happy pushing that message.
Yeah. No, and then people are still stating that regardless of what happens with Ukraine and the conversations that are ongoing, that they will refuse. Maybe it's different. Maybe if sanctions are lifted, maybe as a peace offering, maybe they'll balance it a little bit. But I think a lot of people are currently afraid that everyone's going to rush back to using the Nord Stream pipeline, and I just don't think that's the case. But before I give my thoughts on VG, I do want to say ASTS I think will probably do well. The thing and the reason why I'm not invested in it is because I took the risk in Rocket Lab before it was not extremely profitable, but it's starting to make its way towards profitability. So 2 years ago, I didn't know what to think, right? And so Palantir had a very similar moment back in 2020, 2021. I was cautiously optimistic about the business, but then you started seeing the numbers go in the right direction. And I saw the same thing with Rocket Lab. And you're going to be able to see within the next 12 months profitability out of a space business, which is very rare. And so my thought process is once that happens, it's going to have some sort of Palantir moment as well. And so it won't take much. You think about it, it's a $10 billion company. You don't need to make $20 billion of net income to be able to move the dial, right? You just need to make a couple $100 million. And so the fact that they're growing at a pretty expansive rate, and not only are they being put as a prime contractor to develop the Space Development Agency satellites, that's the first contract that they've won with the Space Development Agency. There's many, many more thousands of satellites to be bid out. And then not only that, but there's literally already thousands of satellites that have been given awards, but nobody knows who's exactly going to launch those into space. And so Rocket Lab is in competition to potentially get a lot of those deals, which is worth billions. And so we're talking about potentially tens of thousands of satellites. It's definitely thousands of satellites, but potentially tens of thousands of satellites, to which you don't just need SpaceX, but you also need Rocket Lab. And you might be able to use New Glenn. We'll see if New Glenn is going to be able to participate in that as well. But to me, I think New Glenn is more so for a deep space vehicle than it is for a low Earth orbit vehicle. But I could be wrong with that, and more than welcome to kind of hit to kind of eat crow if that ends up being more so the case. The thing that I also want to acknowledge for VG is the fact that, yes, I hear you. The revenue was decent. The ops income was decent growth year over year, but that was with the facility just ramping up. And so I think that it's going to be interesting to see the second quarter, because that first facility, for people that don't know, just went on to commercial online dates. So they're now using spot contracts rather than spot contracts. And so the revenues coming out of that first facility will actually decrease year over year. And so what's going to be partly offset that, though, hopefully fully, is the ramping up completely of that first phase of the Plaquemines project. So that's exporting about 12 to 13 MTPA on an annualized basis, kind of looks like now, and it's kind of starting to kind of hit a plateau. So hopefully they get the second tranche of like 12 different trains starting to ramp up. But I think it's pretty interesting. And let me lay out a very simple way for people to look at this. I'm going to be honest. We knew it was overvalued at $24 when it IPO'd. Chris and I ran away from it when they were trying to IPO it at a $110 billion market cap valuation. We said, absolutely not. Fuck that. Straight up. When they did it at about a $40 billion market cap, we were like, it's overvalued for sure. But the reason that I was willing to start dabbling in that is because of this, right? And by no means, I think we were handed a gift for it to be able to go down to below $20 billion market cap. And this is the reason why.
Considering how much they're doing in EBITDA, makes no sense.
Yeah.
But go ahead. Sorry.
No, 100%. No, you're 100% right. And maybe it didn't get down to 18 billion, but it was definitely in the low 20s at one point. And I think that's right, because it was in the $7 and there's only $2.5 billion outstanding. So it's definitely in the low 20s, if not below 20. So the fact that I was picking it up hand over fist, I'm break even, if not actually cash flow, or not cash flow accretive. Positive on a lot of my shares. It was a blessing, because this will be $100 billion plus company. And this is why. The United States, as you've kind of already alluded to, the number 2 export is U.S. natural gas, liquefied natural gas, going to Europe and Asia. The United States has surpassed, over the past 4 years, Qatar, Australia, as the number 1 exporters, right? It was going back and forth between Qatar and Australia, and the United States has surpassed that, and has surpassed that for the past 3 years. You have another additional 50 to 100 MTPA.
Can you put this chart up? Sorry.
Yeah. You have another 50 to 100 MTPA coming online in the coming years. Sorry, this is in BCF? Yeah, BCF. Which makes sense. So yeah, you can see another few facilities coming online this year. Plaquemines being that large one, starting in 2025. Then you have the second phase of Plaquemines coming, Corpus Christi Stage 3, which I'm about to get to in just a second. Then Golden Pass, which I believe is Exxon, and Qatar Energy as well. And you have Port Arthur, etc. So the thing that I want to highlight to people is, right now, and I know the numbers on the chart versus what I'm about to say don't make sense. They are like for like, but it's not what's the numbers you're seeing on the screen. Right now, the U.S. exports about 100 MTPA on an annual basis. With where we're at today, we're going to be ramping up, in my thought process, to about 250 to 300 MTPA over the next 10 to 15 years. Now, if you look and you actually combine all the different projects that Venture Global has in its pipeline, they will be about 150 to 160 MTPA of that, potentially 50% market share of the entire U.S. LNG export business. What does that mean? That you are investing today into a company that will own 50% market share of the second largest U.S. export in history. And so what else does that mean? So let me complete this thought, and then there's a third piece to this as well. Next decade, which is yet to start, will potentially grow into a 40 MTPA business. So 40 over 300, that's about a 13%. So if you were to take Venture Global and Next Decade, you're investing in over 60% of the future LNG export capacity of the United States' second largest export. So what the fuck are you doing if you're not investing in these two companies, is what I'm basically trying to get after. Now, if you're looking for a valuation, and then I want to hand it back to Chris because it got on a monologue, but this is fucking golden if you're following. Sorry, it's literally like I've got it to a T, and I think that this is the easiest way to put it. Is if you look at Cheniere is currently worth about $54 to $55 billion market cap, and they export about 50 MTPA at the moment. Chris has showed a beautiful graphic talking about Corpus Christi Stage 3. They're also doing a potential expansion project at Sabine Pass. That will get them to about a 70 MTPA run rate, up from 50 MTPA today. They're already at 55 billion market cap, right? So about, let's just say for their current export capacity, they're at about $1 billion per MTPA. Venture Global is currently trading at 25 or so $1 billion market cap. So about equivalent, that $1 billion per MTPA, because they're by the end of 2025, they're going to be exporting about 30 MTPA. So you're still roughly that like for like $1 billion MTPA, $1 billion for one MTPA, right? Venture Global will eventually be exporting over 150 MTPA. It's actually scheduled to be over 160. And that's before we've started to see expansion projects. We've seen one expansion project announced to date on their current Plaquemines project. So to think, maybe they're going to do it at Calcasieu Pass 2, maybe Calcasieu Pass 3, maybe they're going to do it at the Delta LNG facility. Who knows? So to date, we know they're going to have 160 MTPA of potential export capacity. So if you get that $1 billion per MTPA again, you're looking at a company that's worth way north of 100 billion in terms of market cap, right? So
there's a couple of things. Let me add. Oh, sorry, if you want to finish. Sorry.
I think that was pretty much it. So I'm just hoping that people fully recognize, like, if you do your math, right, and then you can apply comparable-ish math to Next, but recognize that Next doesn't own all the trains. But that's all I'll say about that.
One of the things that I thought was very important that was highlighted on the conference call was that the next projects that they're going to be doing are going to be brownfield projects. Okay. Now let me explain the difference between brownfield and greenfield, because I think investors, they don't really know the difference. When you do a completely new facility out in the middle of nowhere, there's nothing connected to it. That is greenfield. Basically, you're tearing down trees, you're building up infrastructure, you're doing all of the stuff that's required to get there. So the cost of a greenfield project up front is a lot more expensive versus a brownfield project where there's already infrastructure there and you're just bolting on something to it. So there's two project expansions that they have. One of them, as Matt so eloquently mentioned, Plaquemines. They're looking at ramping up another 18 MTPA at Plaquemines. Okay. And the thing is, they're going to be using a lot of the same infrastructure that's already there, the same jetties, the same marine launch facilities, the same pipelines that basically deliver to the actual site. So all of those things means that the cost of capital to build that additional capacity is going to be much, much cheaper than what it was if you were doing a completely greenfield project in a brand new destination, right? So that's one of the best things that I heard. And so Mike said, the CEO basically said, listen, we have CP3 and Delta, which are going to be our next major things. And those are major projects that are coming down the pike. But we're focusing right now on expanding our capacity at the existing sites. At the same time, they're already negotiating for higher liquefaction rates because the demand is through the roof right now for US LNG. So before they were like, hey, listen, we'll be able to liquefy things and sell it to you for $2 liquefaction fee. Now they're saying we're probably going to charge $2.75 because now there's so much demand that's out there thanks to the Trump administration that we can actually command. And it's not just them that are doing it. Every other LNG exporter right now is doing the same thing. Let me rephrase. New exporter is demanding higher liquefaction fees. And because there's so much demand. Now, what does that mean in terms of profitability for Venture Global? One, according to them, and we can't guarantee this, because sometimes the data can get a little bit up and down. They can produce LNG at a much cheaper price than some of the other competitors because of the way that they do their modular trains. Okay, from what I can see, that's probably true. Like the way that they can do the setup on these things, it's much faster and much easier to do. They've got the experience to do these modular trains, and the cost of liquefying for them is cheaper, which means that they can theoretically give a little bit more of a discount to their to potential off takers, and be able to still maintain a pretty healthy margin. So I think one of the things that I like about Venture Global is that the technology that they have seems to be really on another level compared to your traditional liquefaction facilities that are very, very capital intensive. They're good and it's proven and it's reliable. That's one of the other things that we have to talk about eventually, but it's proven. But at the same time, Venture Global is going with a new technology and a newer way of doing things. And that newer way of doing things is a lot more capital efficient. And one of the I think the good things about Venture Global is that they have this long phase of commissioning where they can basically sell everything in spot. And if spot prices hold up for even a short to medium term, time frame where you can get let's say $7 in liquefaction fees, that's going to pay close to 30% of the cost of the facility within the first 2 years or 3 years of operation, which means now the cost of the cost of building this thing is way cheaper than what your competitors are doing, because they can't do, it's almost like they can't do the, what is it called? Generate revenue as you build model, So right now, next decade, even though they're in construction right now, they're not going to be able to, generate revenue. They're literally waiting on these trains to actually get fully built up and then commission them. Venture Global is no, instead of doing 3 trains generating, X amount of liquefaction, what we're going to do is we're going to make 20 smaller trains, and we're going to literally, as each one of these trains comes online, we're going to ramp up production. So that's why you see Plaquemines. And let me just show the table. So if you look at this is all the export capacity in the US, and we're only going to look at Plaquemines right here. You can see Plaquemines literally just started ramping up in December. Sorry, I went too far back. Okay, there we go. Yeah. So you can see here, they just started ramping up in December of 2024. Okay. Look at this giant increase in production that they have. Okay, this thing is going to leave all of these other guys in the dust. This thing itself, like Plaquemines, is going to, and CP2 combined, that's going to be huge amount of MTPA that's coming online in the next literally maybe a year and a half to 2 years, depending on the construction timetable. So Plaquemines is pretty much all ready to go by the end of this year. They're going to be at full capacity by the end of the year from what Mike Sable, the CEO, guided to. CP2 is already got all the FERC approvals and everything, and they want to start construction as soon as possible. So they're going to start generating that probably in the latter half of 2026. And then all throughout 2027. So you're talking about they already have Calcasieu Pass generating revenue. Then you've got Plaquemines generating revenue. Then you've got CP2 generating revenue. And then on top of it, you've got the Plaquemines expansion that's going to be generating revenue. So you've got a huge ramp up in production that's coming up. And I think it's very underappreciated from a total cash flow perspective, what their cash flow is going to look like probably 2-3 years from now. Now, here's one kicker, and we have to make sure we explain this. As Plaquemines goes into COD, commercial, the EBITDA that they actually generate is going to go down significantly. Okay. So it's not like, oh my God, they're generating so much revenue, it's going to keep going up and to the right. That's the goal. Eventually, they want to get up and to the right. But the goal also is to make sure that their revenue is durable by signing these long-term fixed contracts, so that this way they get guaranteed money coming in. Because the one thing every business likes is getting guaranteed revenue that basically offsets any sort of disruption in pricing and all this other things. Why? Because then you can go to the banks and get cheaper capital. Right now, Venture Global gets interest about 7 to 10% on its debt. So a lot of these facilities, they require a ton of capital up front. Now, if you're borrowing money at 10%, that means that you better be pretty damn profitable. But here's the thing: if you get an off-taker that signs a 20-year contract, the banks are like, whoa, I don't need 10%. You got this great customer in ExxonMobil. They're AAA rated, and they signed a deal that they're going to buy from me for 20 years. Maybe I'll lend to you for 6% as opposed to 10. So now you've got a huge 4% margin coming in additional, and you didn't do anything other than just sign on a dotted line.
Yeah. And another thing about these is that, as Chris kind of alluded to, they're only selling to the current nameplate capacity, but at the moment, in terms of the spot contracts, these long-dated revenue streams that we're kind of talking about, and the thing that we're seeing from Plaquemines and what we're seeing from the original Calcasieu Pass project is that we're actually able to see greater than nameplate capacity. So these things are exporting. I think we saw Calcasieu Pass, the first project, starting to be at like 13, 14 MTPA. And then the Plaquemines is actually overperforming in terms of where it's at today. I think the first half of the project is, I guess it's supposed to be 10, but it's at like 12 or 13 MTPA at the moment. So it seems to be overperforming. And I think Chris alluded to something very phenomenal. Mike Sable in the conference call, he said this in the fourth quarter call in February, March timeframe, but he reiterated this as well. They've already pre-invested into CP2. So they've already gotten a decent amount of investment ready to go. So when they actually hit FID, they actually are going to probably already have the trains coming in. Right?
They've got $5 billion they've already put into the site. So they've already started fabrication and everything. So, it's not a matter of if they FID, it's a matter of when, know. And I think to me, the writing is on the wall. They're going to FID somewhere in the middle of this year. And when that happens, bro, $15. And, we're chilling.
And what does that mean, right? So when the Calcasieu project number 2 comes and they sanction it, and they already have $5 billion invested in it, and within the next 18 months, it's going to be producing gas. That means they are currently as big in terms of export capacity as Cheniere is today, right? And that doesn't include the Plaquemines expansion that we were talking about that they just announced in the fourth quarter call. That doesn't account for Calcasieu project number 3, which is another 30 MTPA nameplate, probably 40 actual MTPA export capacity. And that doesn't account for the Delta project, which is 24, 25 nameplate, but will probably be closer to 34 MTPA of actual export. So at the moment, with where we're at with Calcasieu project and then the Plaquemines project, fully ramped up by the end of this year, we should be exporting just shy of 40 MTPA, right? So just where we're at, 2026 plus, we should be at about 40 MTPA, which is 10 MTPA shy. It's about 20% less than what Cheniere is doing today. And that's a $55 billion business. Then if you sanction Calcasieu project late in the second quarter, third quarter this year, that's another 28 MTPA. That puts you close to 70 MTPA. That will put you at, how the Cheniere is supposed to be expanding later this year with Corpus Christi, Sabine Pass. That'll put them at 70 MTPA. Venture Global is right there. So within 2 years' time, you're talking about a company that is literally within the last 2 to 3 years started exporting LNG, catching up to a company that has been exporting since 2016, 2017. So, at what point do you start to say, wow, these guys are actually, kind of killing it, doing some good work. And it's a godsend that we're actually able to purchase it at $20 odd billion market cap, when it'll be going north of that to potentially over 100 billion. The one thing I wanted to say, somebody noted this, is like, oh, well, Venture Global's X, Next is X, Next is a better buy. Next currently doesn't produce any revenue at the moment. So there's that piece. And also Next first 3 trains are only a 20% economic interest equity to Next. So the rest is going to Total, Mubadala, which is a United Emirates investment fund. So you can't say that Venture Global and Next on an MTPA basis is the same. So you have to do some math when it comes to that. The first 3 trains and Next are challenged at 20%, not challenged in terms of the fact that they're not economic, but challenged in terms of how much equity actually goes to Next Decade. The 4th and 5th train, which have yet to be sanctioned, that's where you start to see some good movements. That's where you get the 40% initial equity ownership and hopefully get it close to 60% if they meet some specific thresholds. And then you have the announcement that they kind of had. I don't want to talk too much about this because we try to keep this a little quieter. But the announcement that they had in the 4th quarter, which is the remaining trains that they have the opportunity.
Stop. We're giving too much information.
Too much. It's too much.
We're giving too much away. I'm still accumulating. Just chill. Chill.
Yeah, man.
So,
me too. Every 2 weeks.
Okay. So this is why we're really bullish on these guys. One other thing to mention, and this is something that you as an investor will learn over time. Market cap is not the same as stock price. Let me explain why. If you have a company that's, let's say right now, in 2030, Venture Global is going to be $100 billion market cap company. That's only a 5x from here. I think that's a lot less than what I want to be in. Okay, well, guess what? These guys generate so much free cash flow. They also buy back shares. And if they buy back a significant portion of those shares, the stock price doesn't go up 5x. It goes up 20x. Okay, so if you look at Cheniere, LNG, they have had a significant buyback program with all the distributable cash flow that they have. Look at this company in 5 years. It went from 45 to 228. If you look at the market cap growth on it, it's only doubled. Okay. So right now, if you had got into, to Cheniere in 2020, it was $43. Now it's 228. But if you look at LNG in terms of market cap, chart. Let me see. The market cap chart. Where the hell is it? Okay, there you go. If you look at the market cap, right? In 2020, the market cap was right here around 13 billion. Now it's close to like 50 billion. So that's a 5x in market cap. The value of the stock has gone up even more. And right now, even with a flat, what is that thing called? Market cap growth. They're still buying back a crap ton of shares, which means every incremental share is worth more and more. So if you look at, where's this damn financials, cash flow, trying to see the outstanding shares.
Yeah, the outstanding shares will help.
No, it's in
I think it's under metrics.
Share count is right here. Shares outstanding. Okay, there you go. So in 2019, they had 225 million shares outstanding. Now they have 230 shares. So look at this drop
almost
off
10%
in total counts. Yeah, almost 10%. And they're literally still doing a ton of cash flow and they're buying back shares. So if you look at even LNG, which is still a great company, by the way. Sorry, let me just look at there. And by the way, they're paying a great quarterly dividend too. So imagine in the future you're getting share-based compensation. You're getting dividends and you're getting share buybacks. It's going to be freaking amazing. So,
yeah, they announced, I think, a bigger buyback in the first quarter. Actually, if you want to pull that up,
right.
And so, it's actually pretty interesting. The net income, the adjusted EBITDA isn't too far off from what we saw. But yeah, where did they say? Is it here?
Right here.
Yep.
Literally 1.6 million shares repurchased for $350 million. So they've right here and they're reducing down debt too. And they're paying a dividend, So I would say, like I said, if you're looking at Venture Global, don't look at it a year from now. Don't look at 2 years from now. Imagine what this beast is going to be in 2035.
Yeah, 100%. 100%. I mean, that's kind of the thought process. And this is a beautiful graph. I love this graph because the one in the middle right here, that you actually see the expansion from between now and the end of the decade, because the majority of that is actually Venture Global, and you also see a Rio Grande in there too. So it's pretty cool because you get to see, not only do you have the Plaquemines in there, but you have Rio Grande, and that won't even include CP2, which will show up eventually once they sanction it.
Yeah. I want to, by the way, thank the Australians for electing super liberal, hardcore liberals in Australia. They have essentially screwed their future natural gas production. So I want to thank you, Australia, for helping out, because without your stupid policies on limiting energy production, maybe Australia could actually make some money. But now all of the projects in Australia are uneconomical. And now your government is also being a dick to that energy industry. So you're going to lose out. At least the Canadians, they're starting to like become a little bit more like lax with trying to do some of the exporting. But thank God, whenever these liberal governments, they come in and they limit the shit out of their industries, it's great for the country that's actually like, let's develop our industry. So right now, everyone, like all of these countries, they're pulling back. They're like, oh no, we don't want to do. Okay, don't do it. We're going to do it. America's going to be goddamn energy super, like a giant. And we're going to be energy dominant. By the way, that's the other thing with this administration. They're not like the Biden administration where they're like endless paperwork after endless paperwork. These guys are like, let's ramp this thing up. Let's get America to be like, one day you will see me and Matt come on the stream with freaking like and I told Matt, maybe we should do this with like the Saudi, like the outfits that they have in the Middle East. I just got to ask one of my friends, like if I could do it without being like offensive, if it's offensive. But basically, you know, like the headdress with the what are they called? With the thing.
Yeah, yeah. But I want to say I have no comment on the Australia thing. I just need to put that out there publicly.
Yeah.
And the Canada piece, yes, I'm with you there, Junebug. So Canada, they have the Canada LNG project, which is supposed to start this year, first phase of it. That's a combination project between Mitsubishi, Petronas, which is the Malaysian oil and gas company, Shell, and Korea Gas, and I want to say one other company, but that's going to be 50 MTPA. And there's a few other small projects that are less than 5 MTPA that Canada is getting going. So at the moment, that will be off the West Coast, kind of north of Vancouver, if I believe, and that should start this year. But other than that, it's rather limited in Canada, which is unfortunate because they have a phenomenal business starting to show up in British Columbia that is non-oil sands related. So a lot of people give them slack because a lot of the oil that we actually purchase from Canada is oil sands. And, you know, people talk about how it's dirty, you know, and the carbon intensity is much higher. And so that's why a lot of the super majors have kind of backed away from it. But they actually have some really good plays, like the Duvernay, the Montney. Can't say too much other than that. But I mean, Canada's doing really well with respect to natural resources. They have a great natural resource base, and not only, you know, natural gas, oil, but also gold, silver, uranium. I mean, they do everything. They have it all.
Yeah, the energy transition is going to happen to renewables in 50 years. Maybe 100. I don't know if it's even like remotely there, but the entire time you're still going to need more and more and more bridge fuels to get to that level, to get to where we need to go. You know, so I think some people are optimistic about nuclear. I'm optimistic about nuclear myself, but once again, nuclear can't be used in every single industry that's required, and it takes a really long time to develop these giant facilities. And some of the SMRs that are coming out, there's still unproven technology that's going to take a really long time to get to commercial scalability. So, you know, I think right now natural gas still high in demand all over the world. You've got these new countries, developed markets that are like they're just begging for more natural gas, like India. You know, they're looking to increase their imports by 60%. You know, you've got literally like whole parts of Africa and South America that are also becoming more and more developed as countries. So what are you going to need? You're going to need energy, So, and like I said, the Venture Global and America is ready to provide a low cost solution for natural gas. I mean, and not to mention now with this whole Russia thing, the supplier Russia, like the Europeans have actually a plan right now by 2027 to completely cut off all of Russian gas imports. So where are they going to get their gas? They're going to get it from America, 100% ally, And that's the other thing that's going to be something interesting to look at with regards to these trade deals. Like the Trump administration is really pushing all these countries to basically, close the trade gap. Well, one of the easiest ways that a lot of these countries can do that, buy more US LNG. It's so simple. It's like, they have a commodity we want, and they're willing to sell it to us at a cheaper price. And at the same time, that fixes our issue with this trade imbalance nonsense. Buy more US LNG, done.
I think this is my prediction, and it's something that you guys will have to hear. Kind of like how I didn't think oil was going back to 80 or 90 bucks, and everyone thought I was an idiot, right? And here we are at $60. I have a very firm prediction. Right now, the United States has done a phenomenal job with its ingenuity and ability to get the Permian Basin up to 5 to 6 million barrels a day. But we are hitting a plateau of that, and eventually we will start to hit a decline as we go into the latter half of this decade. And, will that be 2028? Will that be 2030? I don't know. But what I will say is right now it's very easy for us to look at how cheap natural gas is comparatively to the rest of the world. Well, two things is happening, right? And we've been talking about it all pod, but let me just kind of simplify it for you guys. Oil production will eventually come off of a peak in the United States within, I would say, the next 5 years or so. Not consumption, but production, right? We produce about 13 million barrels a day. Half of that comes from the Permian. The Permian has been doing phenomenally, but I think we're hitting a plateau and we'll eventually hit a decline. 2028 to 2030 is kind of where I'm thinking. So with that, you're going to start to see less and less natural gas production coming out of the United States. Meanwhile, we're going to start exporting more and more of the natural gas production. So you're going to start hitting a floor in terms of Henry Hub gas prices, I anticipate, in the United States in the latter half of this decade. So for those of you guys that, might be thinking about solar and stuff like that, give it some time. Henry Hub is cheap right now. I think we're going to continue to see it be cheap for the next several years. But in the 2030s, when production in the United States continues to go down and natural gas production will start to go down, and we export more and more of every barrel of every MCF of gas that we make, natural gas prices are going to go through the roof in the United States. And I wouldn't be surprised if that leads to $20 an MCF worldwide as kind of a natural progression. So I'm curious where that kind of ends up, but I've been thinking that within the 2030 timeframe, we're going to see a floor of about $6 an MCF, kind of in the shorter term.
Should we be buying land in Haynesville? Is that what you're saying to me, Matt? Should we be going out there like a bunch of landmen and just buying these mineral leases in the Haynesville?
No comment.
I mean, that's essentially okay, so just for everyone here, Haynesville area of Louisiana / Texas, is it part of Texas or Arkansas?
No comment.
Okay. Well, Haynesville is a region that has a ton of natural gas. It's dry gas, which means that it's not like when you drill, you get oil as a byproduct. You get literally like natural gas. And the challenge, though, is that when you want to produce from Haynesville, it costs roughly $3 of BT on a was it $3 MMBTU to break even, roughly $3. So if you're able to buy acreage over there, and then eventually the price of MMBTU goes from $3 to, let's say, $5, it's a lot of money that's going to come your way. So now all that land is going to be nice to own. So that acreage is going to be good. So any company right now that owns a ton of acreage in the Haynesville, and if Matt's prediction comes true, your land values are going to skyrocket. So
I want to iterate to people though that a lot of the South, not so much in the Northeast, but a lot of the South, you'll see that there's a difference between owning the mineral rights and owning the land. So if you guys are actually venturing, I just don't want you guys to get screwed to be like, oh, this land is dirt cheap. It's like, well, it's probably because it doesn't come with any mineral rights. So just double check that it hasn't been decoupled. A lot of times you'll have big corporations and small private equity, et cetera, owning the actual mineral rights itself, but not actually owning the land, and then vice versa, right? The common folk own the land, but not the mineral rights. So just be cautious associated with that.
Well, here's the other thing too. Are companies out there that are public that do own mineral rights. I'm not going to say which ones because that's for me and Matt to look at together, and we'll talk about it. I know. So this way, these guys, when oil prices are shockingly down, the value of those rights go down as well. But when the price goes up again, the value of those rights becomes super expensive. So you find those companies that own those rights, have them and are publicly traded, and they bought them when things were super cheap. You're going to do well, So, but we're not going to say which ones. So June knows one of them, Texas Land Corporation.
I think that was too expensive for me, though.
That's TPL. Yeah, they own a ton of acreage in Texas, especially in the Permian Basin. So, but there are others. And me and Matt will dig them up. And for our viewers, if you want to tune in, subscribe, and you'll know which ones they are. See?
Mm-hmm. Interesting.
Or you can ask ChatGPT.
I wasn't going to say that, but Grok has a lot of good information. If you know what to ask, though, that's the problem is that you have to be specific sometimes when you ask Grok, because it'll, just with anything, right? Like if you just say oil and gas companies, like they'll give you whatever the hell you want. But if you got to be specific and actually know what you're asking. No hate on the Rocket Lab ASTS thing. I think, both companies, it's like Next and Venture Global, right? You really have to understand where they are in their life cycle. I'm cautiously optimistic ASTS will do well. It's just one of those things where it's like, with the amount of money that I had in Rocket Lab and that I was fortunate enough to kind of get in slightly early, investing at $1.52 billion market cap, and now it's north of 10. So do the math there. I mean, phenomenal run so far and will continue to do well. It's like, do I want to bet in a company that currently isn't making revenue? And yes, it's got contracts in hand, but is it actually getting revenue from those contracts? Not yet. It could be something where ASTS in a year, 2 years from now, and this might mean that I lose out on a 2X, right? But if Chris is right and other people on X are right, and I'm not saying I believe this, but this is what people are thinking, they think this can go north of $100 billion, right? Just based off the opportunity that it has. And if you look at what SpaceX has, which is a $300 billion market cap estimate based off recent valuations, and you say, okay, well, why wouldn't an ASTS trade for something like that? I'm okay waiting for it to be a $20 billion company if they actually end up starting to get that flow through. And it could very well be that I miss out on a potential 2X here. It's already up 4 or 5X from where it was, just 2 years ago. I'm okay because at the end of the day, you can remove some of that risk. Now, if you have, let's just say, some money that you don't mind parting with, and you believe in the story and you think that they have, good work so far, then, it wouldn't be dumb of you, especially if it's money that you can part with. But as always, don't invest money you can't afford to lose. And always just acknowledge that not everything is cut and dry, right? There's a difference between the risk profile for next decade and the risk profile for Venture Global at this point, just based off of what where they are in their current cycle of business.
One thing I just have to say, I feel so bad for all the folks in Tellurian. Like, I feel for you guys, man. Imagine getting sold this idea that you're going to become successful. You're going to do really well. And you got in at the ground floor of something. And then Suki screws you over. And now you get sold to Woodside. And then Woodside literally takes the money that they based. God damn, I feel so bad for investors from Tellurian. I mean, thank God we had Tel Z, which made sure that we got paid, and we got paid well because we were in the debt, not the equity. But man, how shitty of an existence would it be to be like a Tellurian investor for like 5 years and basically get handed nothing? And who comes in? Woodside buys them for $1 billion, sells a bunch of stakes, sells their upstream assets in the Haynesville that Suki bought cheaply to this other company. This other company now is sitting on all this acreage. And then at the same time, all the approvals, all the stuff, just because your boy Suki couldn't close some deals. Like, God. And Woodside is getting a fully, like...
Yeah, they're getting a ride. It's crazy.
It's... Imagine right now you have an apartment building that's like, I would say 60% done. You've already got all the permitting. You've already got all the foundation work, everything. And then all of a sudden you lose out and all your existing shareholders get wiped out. And the new guy comes in and basically just builds something on top of it and makes all the money. It's just, God, it's horrible. Horrible.
Yeah. People are asking what our price targets are for some of these things, man. I don't look at 1 to 2 year price targets for a lot of these things.
Yeah.
You know, I look at 10-year down the road personally. So, I mean, if that's what you're looking for, you know, that's your MO. I get you. Get after it, my friend. But I don't even know, you know, if I can predict what some of these things could be in 1 to 2 years. I more so look at where it is today. Where do I think it's going to be in 10 years time? And kind of come up with an idea as to, okay, that's an annualized X, but I'm not saying, oh, I need to make 30% in 2026 annualized, right? I'm saying it might be down in 2026, 2020. It's all dependent on the milestones achieved, right? So it's really dependent upon what happens. And the market could value, let's just say the market, and this is one of the things that why I bought into Venture Global at a $40 billion market cap at IPO, was because I didn't know if they were going to say, holy shit, this company is going to be worth $150 billion one day, right? And they could have, you know, basically, I mean, look at Palantir, right? Like, I'm not trying to be an asshole, but like, who would have thought that Palantir would be worth $300 billion, right? At the current revenue that it has. So granted, we're talking about apples and oranges for 100% certain, but sometimes the market rates things on what it'll be valued at 5 years from now. And sometimes they rate it at worse than what it's valued at or generating in terms of income today. And so we saw that pendulum swing to Venture Global. And I'm just very happy I got in at the prices that I did, buying down. And even still, like, we see our average here in the public portfolio at $12.85.
Maddie, if you knew how much Venture Global I had, bro, I have a lot of Venture Global. I'm pretty sure I'm gonna have to like borrow some money to pay some bills because I bought so much Venture Global.
Hey man, I know I need to. And that's the other thing, like that's the thing, is like, you know, people are asking about SMCI. It's like, this is the problem sometimes when you follow people into things, right? And you don't fully understand. I got at SMCI when it jumped up to $50-$60 and sold. I made my money and I was out. And, you know, I thought about in more recent times when it dipped back below to the low 30s, buying back in, but unfortunately I missed that. But that's the thing. Some people are probably still holding on to SMCI, following me, when I straight up said, I'm selling the news. And I sold the news and I timed it well. So, you know, that's the thing. When you follow people into trades, it's not just about when those people enter, but when they exit.
Yeah.
Right.
Yeah.
Because some people might buy in until it gets a certain price, and once it's that price, they're done, dusted. And so you have to be cautious.
All right. So how are we doing total portfolio wise versus the S&P?
Versus the S&P. So let's just walk through this really quick, and then we'll get to the S&P comparison year to date versus the trailing 12 months. So Venture Global is our largest position. It's about 40% or so of the portfolio. Cost base is about 1285. So we're still down in the public portfolio. But other things are doing rather well. Rocket Lab being one, BPYPM, BPYPN, holding in single digits, but they're giving us a decent dividend. Next is kind of returned a little bit. Hoping it gets to $8 or $9 by the end of the year, but who the hell knows? Very dependent upon the Train 4 sanction. New, that's another one that we bought more recently. I think it was a decent purchase price at $12.44. Not the best, but decent. Carnival's starting to return. Celsius is back up at mid-30s, which is decent. Bitcoin has been doing well for us. I'm glad I kept this in there. HIMS, man, 300% return. Crazy. I wish we didn't sell all those shares that we did. SMCI, 21%. Norwegian, what the hell happened to that, Chris?
Their earnings, when they came up with guidance, they kind of said that they were trying to be a little bit more judicious with their bookings to make sure they're more profitable. So in terms of like total future bookings, they were a little bit lax. So the way that they explained it on the conference call was, look, we're not trying to get every single incremental dollar. So we're not going to fill our ships just to fill our ships. Like, we want to maintain a certain level of occupancy. But I think what they're trying to do is maintain margins, right? So Carnival's business model is more like, this is going to sound hilarious, like pretty funny, but they're more like Spirit Airlines, where they're like, we need to make sure we book the entire thing. Whereas Norwegian's like, yeah, we're like Delta. Like, we want to make sure that, you know, we're not the we're not looking to get full occupancy. We'd rather maintain higher margins.
That's what I do with my Airbnb, man.
Yeah,
because then you'll have literally like anybody and everybody just like showing up, partying at your house, because it's easier to just, you know, have a party at your house for $400 for the weekend, and have somebody else clean it up than it is to have it at your own house, you know. So
if you look at like Carnival, they're booked out all the way, like literally they have like bookings into 2027 now. Like, that's how far out they've booked. So one of the business models that and this is the part that I think a lot of people don't understand about business models. Like Carnival, they generate so much in forward tickets, and then they do all this money in deposits. That's free money. That's carry. So that's basically
the Airbnb business model.
Yeah. So you're basically sitting on all of this cash, and this cash is you can use to basically pay down debt at super expensive debt. You can pay it down. And the thing is, you're not going to render that service for a year and a half. So that's like literally you're getting free money for a year and a half. Like, you're getting to borrow money for free, you know? So Norwegian's a little bit more selective with that. But the other major things with the difference between Norwegian and Carnival, though, is Carnival is like, we are going to focus on getting our debt levels down. So as Carnival transitions to non-investment grade to investment grade, and their debt to GDP, debt to EBITDA goes down materially, you know, people are more willing to lend money to Carnival at cheaper prices. So one of the things that I saw, you know, yesterday was Carnival was able to refinance debt that they issued during COVID that was issued at 7.5% to now issuing it at, I think, like 5 or 6%, like roughly 5 into something for like 7 years. So that means that now Carnival pays less in interest charges than they did before. And that's literally goes right to their bottom line. Now, why are they able to get that kind of preferential pricing on their debt? It's because they've shown that they're really good at maintaining their balance sheet. Norwegian, on the other hand, is more like, we are going to grow. So they've got a bunch of ships on order, and their order book is like packed solid for the next 10 years, which means incrementally they're going to be taking on a lot more debt. So, you know, if you look at Norwegian's growing really fast because they've got a bunch of ships coming online. But in terms of cost of capital, right now, the cost is going it's literally staying the same for them or going up a little bit, primarily because they're taking on more debt for new ships. Carnival's like, we're not going to order a lot of new ships over the next like 2-3 years. We're going to focus on paying down our debt. So I think that's one of the major things. So as interest rates remain higher for longer, Norwegian's way of doing things are not as value accretive to shareholders as Carnival's is. But and let me caveat this: if interest rates go down, so if Powell starts to cut interest rates, Norwegian's strategy is going to be a lot more profitable. Yeah. Because now they're going to be able to issue debt at cheaper prices because the Fed funds rate is cheaper. So now you can basically maintain your CapEx schedule, and the cost of capital is a lot less in the future, which means that your earnings are going to look a lot more attractive going forward. So that means that the price of Norwegian should theoretically go higher and go faster than cruise lines. Carnival.
I'm a big proponent of investing through the cycle. The business cycle is investing all the time. Yeah. Personally, I see that in the oil and gas industry where people swing the pendulum of invest now, hold off, invest now. And it's tough to then generate big projects over time that continue to pay you, in good times and bad. So not to say Carnival's in a bad spot. I think they'll do fine as well. But I would personally rather them, within the next year or two, start sanctioning more and more boats. Because the last time they're getting a boat last year, I think, or are they getting one this year? I don't remember. It's not important. We can talk about it at a different time.
Yeah. The other thing is with regards to cruising, I know some people absolutely hate cruising and some people absolutely love cruising. So it's just a matter of preference. Like, trust me, there's people out there when it comes to cruising, they literally they buy like 5-6 trips in advance, and they literally just love going on cruises. There's a whole community of them. So by the way, the other major things that like Carnival has is that they have like some islands opening up in the Caribbean that are going to be very value accretive to shareholders, because what it is you're not buying a whole, you're not buying a brand new ship. So if you look at this right here, strategically, their ship counts. So they added 3 to 4 from 2018 to 2023. And then in 2024, they added 3 brand new ships. In 2025, they have 1. In 26, they have nothing. In 27, they have 1. In 2028, Carnival has a ton of operating cash flow, and none of it's going towards CapEx. It's all going towards debt reduction. So by significantly lowering their capital costs, now they're saving a ton of money, and it's going into reducing debt. And so you can see here, look at the customer deposits. In 2019, they only had $5 billion in customer deposits. Now they have $7.3 billion in customer deposits. So if you think about this in terms of borrowing costs, right now, if they were in the open markets to borrow, it would cost them like 7%. So 7% of $7.3 billion is a net savings of $490 million per year, because they're able to sell tickets ahead of time. Okay. Think about that for 2 seconds. Crazy. And then they have, look at this. They had, and this is something that I went over on my Patreon. So all the people that are on my Patreon, congratulations. I said this was going to happen, and it actually did, which was they refinanced $2 billion of debt that they issued during COVID. They issued it at 10%. Okay. Because they were not generating revenue at the time. Now they issued the new rate at 6.1. So that's 4% in savings. So on a per year basis, that's $80 million that drops to their bottom line for doing nothing but just signing a piece of paper. Another one that they did saves 45, and another one 18. So $145 million goes directly to the bottom line, all because you're able to sign some pieces of paper. So this doesn't require any additional investment. This doesn't require any additional work. This is literally just CEO doing a good job managing his capital flows and able to save this money. So this $145 million, it goes right back to shareholders, And if you look at their maturity schedule, they've got a very well maintained maturity schedule. Another thing that a lot of people really missed out when it comes to Carnival in the past is that if you look at what they're doing with their credit rating, as they're paying down their debt, their credit rating is going higher and higher and higher, which means that their cost of capital is getting better, better, and better. So whereas before in the past, it would cost you X amount of money to borrow, in the future, because your credit rating is better, you're able to borrow at a cheaper price, once again, making your profitability get higher. So right now, before in ROIC, they're generating almost 12% in ROIC in 2026. So you can see that this is a very, very well-run business. If you just listen to the conference calls, just listen to one conference call, and literally it'll, like, Josh Weinstein this dude is freaking like phenomenal, and their CFO, amazing dudes. They know exactly how to approach the situation and make a ton of money. Matt's like, stop being a pussy and buy VG. Yeah.
I said that in the Discord yesterday. People loved it.
Yeah.
We got to get you to listen to a conference call for a Replit.
Only if he eats another hat.
He might.
More hats. Eat more hats.
So where we're at, so year-to-date performance, we're still underperforming by about 4%. So we're down 4% year-to-date comparatively to the S&P, which is about flat. That doesn't include today. I don't really know what the market did today. I wasn't able to catch up on it. 1 year return, we're still 3x comparatively to the 1 year return. A lot of this I anticipate is dragged down by Venture Global because we're still down, 12% or so on that.
Yeah, it's 4% in our portfolio. So
yeah, so let me see. What was it? Yeah, 40% of our portfolio, we're down 14.5%. So hopefully this in the next coming months, I mean, who knows? Maybe it'll rebound, maybe it won't in terms of getting back. But I'm cautiously optimistic that, I mean, we're already $11. I'm pretty surprised by that, to be honest with you.
yeah.
So, yeah, not sure what the next moves are.
Next moves are just buy, hold, and chill, right?
Yeah. Cool.
I am a little bit disappointed that we didn't buy more Bitcoin. Because I think with the current administration's like policies, I think Bitcoin is a great hedge against what's happening in the background.
It's the first time I'm hearing you say that, Mr. Patel.
No, it's true. It's true. Only because the challenge is this. On one side, the administration is doing these tariffs, right? Which means that you want a weaker US dollar. So relative to the US dollar, all the other things that benchmark against it are going to go up in value. So one, Bitcoin is going to gain from that. So that's number one. Number two, with all this additional tax cut and spending cuts, that means that we're going to be doing a lot more debt issuances, and fiat currency is going to keep going down in value. So it means Bitcoin, which is limited in terms of total Bitcoin that's going to be available in the future, it's literally going to keep going higher and higher. So I know some people are laughing at Kathy Woods about Bitcoin possibly being like, what did she say? How much is going to be, like $2 million? Or Tom Lee said it's going to be like $250,000 by the end of 2025 or something. I hope Carlos and Vitaly are not watching this, but Bitcoin could get there. I know you've been a big Bitcoin proponent for a long time. So
yeah, I wish I had more. I wish I invested as much as confidence that I've had that it was going to do well. But I thought, I don't know, everyone was so bearish. I mean, I have enough where it's going to change. It's not going to be life-changing, but, well, I guess it depends. If it gets to Tom Lee numbers and Mike Saylor numbers, then it definitely will be life-changing.
I think if it goes down significantly, and that's the one thing I like about Bitcoin from an investing standpoint, Bitcoin has these moments where it gets cut by like 50% at times. I mean, if you think about Liberation Day, this thing went down to like $77. So I think Bitcoin is one of those things that when the dips come, and they do come, hold your nose and buy some. I have some Bitcoin, by the way, not a lot. Like I think it's like maybe like barely like 10% of a Bitcoin. I just bought it just so that I'm like, yeah, whatever. I have some exposure and I'm up significantly on that. I'm like, let me look at this thing like 20, 30 years from now. And I'm like, how much is the US federal debt going to be? And then if you think about how many Bitcoin, I'm like, all right, You know, the only risk to Bitcoin, to be honest, though, is that if it gains too much power, I wonder if the central banks come in and say we need to get rid of this thing. Otherwise, our game is over. What do you think about that?
I don't know. I really don't. It is pretty interesting that you're able to know where all of it is at the moment. So, I mean, Michael Saylor has, and his companies has about 1/40th of all the Bitcoin. And is it that? Yeah, 1/40th. Yeah, it's got about 2.5% of all the Bitcoin. It's got 500,000 out of 21. So the U.S. government, I think, holds about the same. Yeah. So they own about 2%. 1 million of it is lost. So 5% is lost just because of Satoshi's wallet and it hasn't moved. Maybe it moves and maybe it doesn't. I don't know. But, you know, that's worth hundreds of billions and it's just been sitting there dormant since like 2010.
The one thing that I am, and this is something that I hope these Bitcoin mining and Bitcoin holding companies, they, I get what Saylor is trying to do. To be honest, I really do. Like this whole thing would let me just get more and more Bitcoin. But the challenge is if he runs the business and the value of Bitcoin drops low enough, and at the same time all the debt is due and he's forced to sell Bitcoin, that's something that worries me. Because the thing is, like, everyone is going to crowd around the trade. But then, like, when selling happens because of some sort of credit event, so one of the things with Saylor, he's so into Bitcoin right now that I feel like he's taking a lot of risks with MSTR by issuing, like right now he's issuing preferred shares on his Bitcoin holdings for about 10% per year. Okay, like he's taking on fiat currency because he thinks that fiat is going to devalue by 10% every year. And so it's more value creative to just buy Bitcoin. But the thing is, you're buying it with debt. Okay. So that's not good because then you can theoretically one day become over leveraged. And I think that's something to just be wary of. So if someone to ask me, like, Chris, would you buy MSTR or would you just buy Bitcoin? Like, I'd say you should probably just buy the Bitcoin, you know, especially if right now you're buying MSTR and the NAV is way in excess of what the current
trading price of Bitcoin at a minimum.
Yeah. So just be careful with that. That's all. You know.
Yeah, because let's just do some quick math. So they have about 550,000 Bitcoin at, let's just call it 111,000. That's a $61 billion value, right? And not all of that is free and clear. So they do have some debt. Keep in mind, right? And the company's worth 110 billion. So it's, you know, not exactly 2x the Bitcoin value, but it's a premium to the current valuation of the Bitcoin. So, you know, you're right. What if Bitcoin decides to drop in half? It is technically over levered in that respect. So, but people are asking, do you buy the physical Bitcoin? It really just, I think, in my opinion, depends upon your ease. Because I think a lot of people, it's not like it used to be. When I started buying Bitcoin ETFs, they were charging 2.5% expense ratios. Absurd, right? But you think about it, if you're getting on average 20 to 30%, who really gives a fuck? But now you have these ETFs that are out there that are charging less than 0.25%. GBTC is my favorite. That charges 0.15%. Sorry, not GBTC. BTC, Grayscale, but it's the mini trust. It charges 0.15%. So that's the best at the moment. It's really up to you, guys. And the thing with this, and I'll end with this with the Bitcoin, and I know it's probably time to call it a night because we almost been going 2 hours, is really it depends upon, do you want to write some sort of covered calls or anything like that against it? And that puts you into danger as well, because how aggressive are you going to be? Are you going to try to write covered calls super close to the money and then just lose your fucking Bitcoin? But I mean, in reality, I think it always goes back to, what are you using it for? Are you using it to eventually get back to some sort of dollar amount? Because then in that respect, you know, just buy the ETF. But a lot of people think and buy Bitcoin because they think the dollar is actually going to fail. And so they say, I need something that can be traded in some sort of other denomination other than the US dollar to get me out of dollars. Because if the dollar goes to shit, technically you need some sort of currency that can be used. So it really depends, really what you really think. I believe that the institutions are doing okay. The thing that's scary is that they're getting into Bitcoin futures, and that might be what causes kind of an exacerbation of the volatility in Bitcoin. So, but I try to tell people, man, it really just depends. Like, I think selling puts on Bitcoin, especially in a bullish market like this, is literally free money. You might have those pullbacks, but as long as you're not over leveraging yourself selling puts like that, you'll be okay. And the thought process is like, with respect to that, if you're able to just ride it, wait for it to kind of peak out. Don't sell puts, obviously, when it's peaking out. But once it gets into crypto winter, which I anticipate will be in 2026 throughout 2027, before we start the next bull run, probably in early 2028 timeframe, you could sell puts once it's down, once it's pulled back 40, 50, 60% from all-time highs. You can start selling puts again. And yeah, maybe it drops down. Maybe it drops down to minus 60% or 70%. But, you can roll out in time a little bit. Don't get too aggressive. Don't oversell. And once you really, truly find that bottom, if it goes down 60%, 70%, then once again, you can start to generate that income or buy it, once it gets back down to that point. So,
yeah. All right, brother. I've got to go.
Yeah, me too.
But we should do one episode next week. And one of the things I really want to talk about is this right here, fear porn, how to understand fear porn and get away from it. So like right here, breaking, U.S. banks currently facing $482 billion of unrealized losses, an increase of 33%. Oh my God, the world is coming down. Everyone sell your bank stocks and go, like, bro, stop with this fear porn, man. There's so many people on Twitter that put the fear porn out there and then they cause things like runs on banks. And then they realize, oh, wait a second, there's actually not that big of a problem. So we'll dissect all of this stuff. There's like another thing that's happening with PE world that could actually be a major problem that no one wants to talk about. I think Bill Ackman mentioned it, but I think that's something that we should probably talk about.
What do you mean PE world, like private equity or?
Yeah. Did you see the thing with Bill Ackman in like Harvard? Harvard has like a $50 billion endowment, but 80% of the money is locked away in PE funds. And the thing is, the PE funds are like marked to market. So they didn't actually mark them correctly. And so they could actually be worth 40% less than what they were before. And the thing is, like, they're scared to mark it down. So here, before I got to go, let me just tell you, like, so let's say I bought this iPhone 5 years ago for $500. On my balance sheet, if I say this iPhone is still $500, that would be false, right? But how would I know what the value of this iPhone actually is? Well, the way that you would know is because if I tried to sell it to Matt says, hey, this is actually only worth $100. This is what I'm going to pay for it. Now I have to recognize a $400 loss. You see that? Now, the thing is, everyone's like, oh, Chris has got that $500 phone that he bought 5 years ago. PE funds, a lot of them are in trouble right now. So a lot of the stuff that they have investments in, the value of those investments have gone down significantly, but they're not marked correctly. And so Bill Ackman is saying Harvard, Yale, all of these guys, they're running into liquidity problems because of the Trump administration and how they're kind of like taking federal funding away. So Harvard has to go out there and sell its investments. And the investors on the other side are like, that's not worth $100. That's worth 60, And so Harvard is looking at some major problems right now. And so the Trump administration is literally like, they put the knife in the back, but now they're like twisting it. And Harvard is like literally feeling the pain right now. So yeah. So we should talk about that another time, but it'll be a fun conversation to have.
All right, my man. Much appreciated.
Right. Have a good one, brother.
Thank you all. Talk to you guys on the next one.
Take care.
Greed is good. the stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good. Huge upside potential, upwards of $60,000.